I'm going to go over why covered call ETFs are awful for providing income in your retirement. This includes QYLD, XYLD, RYLD, JEPI, DIVO, in fact, any of them. And you're going to want to watch this video to the very end because I'm going to show with backtesting that these all heavily underperform just owning the index and selling shares in any type of market environment, bear markets and bull markets. My last video, why no one should buy covered call ETFs, was largely positively received, but there were still some that have the common misconceptions about these covered call ETFs, thinking they will perform better in down markets than my strategy of just buying the underlying index and slowly selling shares. So I'll read a few of the comments and explain why these are in fact incorrect. QYLD are good income options for retired people who need more income than dividends from VTI can provide. They don't have to sell shares in down markets. They can just keep collecting dividends. Well, this is the exact problem with covered call ETFs like QYLD. By selling covered calls, you are in fact guaranteeing you sell your shares in a down market, and I'll explain this later in the video. Not buying JEPI for market outperformance, buying JEPI for lower volatility and steady monthly income to supplement SSI in retirement. No real point in owning JEPI if you are years and decades from retirement. Well, again, this has the same problem of that you really don't have lower volatility. You have all the same downside as the regular index, and you will not receive steady monthly income because if your covered call ETF goes down 50%, your monthly payments will also go down 50%. And another commenter, he basically says sideways and down markets are better for most covered calls, and less so strong in bull markets, but they even rise in them too. So again, this is incorrect, as I'll show you with some backtesting that the covered call ETFs actually do much worse in bear markets. And even just the simple strategy of selling the shares will actually produce a better income and provide you more capital appreciation as well. And along here he says, can you really reliably take out 7 to 15% annually and expect the S&P to maintain its value during a less friendly stock environment? Well, I'll show you later in this video that you in fact can. Another commenter, this video is actual garbage. And he goes on to basically saying, whereas the 1% dividend for month from the QYLD is guaranteed. Well, yes, you will always receive 1%, but if QYLD goes down 70%, your 1% payment is going to be 70% smaller than before. They buy it as a quasi-fixed income instrument. QYLD is basically the highest paying bond out there. Well, the thing with bonds is they pay you a provided fixed amount every month that's consistent in up or down markets. With QYLD, as I've explained many times, if the market goes down, your payments will go down as well. And when the market recovers, QYLD will not recover and your payments will also stay down. And another commenter, I think most people who hate QYLD don't understand. It's not an investment. It's not a growth tool. It's an income tool for old people in retirement so they can get more dividend income per month than what you would get from an S&P 500 fund. They can hold on to their shares, collect monthly income, and can pass on the balance of the funds to loved ones when they pass without giving up the whole thing to an insurance company. Well, again, this is the same problem as before, as this commenter doesn't realize that when there is a bad bear market, QYLD will dramatically go down in value. Not only will your initial invested capital potentially reduce 50, 60, 70%, your amount of monthly payouts will also reduce 50, 60, or 70%. So to demonstrate how poorly covered call ETFs perform in bear markets, I'm going to show you a covered call fund started in 2004 called the Nuveen S&P 500 Buy and Write Income Fund, ticker BXMX. And again, this fund has the same premise as all these other covered call ETFs of trying to replicate an underlying index such as the S&P 500 and then selling index covered call options against the fund to provide risk-adjusted portfolio returns and provide regular distributions. So in comparing BXMX to the S&P 500 since 2004, you can see even after the 2008-2009 financial crisis, the S&P 500 is massively up, while BXMX is down over 30%. Just for a little bit of information about BXMX, this is a covered call fund that provides about a 7% yearly yield. And typically, the higher yielding a covered call ETF is providing, the worse it's going to do during drawdowns. This is why a covered call fund such as QYLD is in an overall downtrend compared to XYLD, which has been going sideways. And during the 2008-2009 bear market, BXMX fell from its peak 62% down. This is worse than the S&P 500. So for my backtest, I'm going to look at BXMX since inception for a 10-year period to show you how this performed going through one of the worst bear markets in history and then the subsequent recovery, and compare this to just buying the index and solely selling shares. So here are the results for my 10-year backtest of BXMX compared to buying SPY and just solely selling shares. So obviously just buying the SPY itself is going to produce the greatest return, but you're not getting as much yearly distribution as you want. And over these 10 years, there's an average yearly dividend of 3.48% if you just bought the SPY and held it throughout the bear market. In our strategy of buying SPY and solely selling shares, there was a slight loss in our initial investment of $1,489, but we produced $7,800 of income by selling shares, and we also received dividends of $2,233. As you can see, the dividends of the SPY plus selling shares is lower than just the dividends you get from SPY because we have less shares along the way. And this produced an average yearly yield of 10%. And the reason why I've done this to be a higher yield than BXMX is I can already see people saying, well, XYLD yields 10%. So I want to show even against a lower volatility and lower yielding covered call ETF, which should outperform ones like QYLD and XYLD during bear markets, the strategy of buying the SPY and selling shares is still superior. And now with BXMX, as you can see, there was much larger loss on our gains as we lost $3,655 of our initial $10,000 investment and only got $6,700 of total distributions. This is in comparison to our over $10,000 of total distributions from the SPY plus income strategy. So as you can see, over the 2009 crash, owning the index and selling shares outperformed BXMX. In fact, we got over a 2 times total return with higher yearly payouts. And also, due to the lower tax rates, you're actually going to receive more monthly income as well. So as you can see, owning the index and selling the shares outperforms covered call ETFs in both bear and bull markets. And if you haven't watched my previous video of why no one should buy covered call ETFs, I show the same type of backtesting and the Excel sheet behind this backtesting showing it also outperforms in bull markets as well. I'm going to now show you why covered call ETFs do so poorly in down markets. So in the first chart here, I have QQQ as the orange line and QYLD as the candle chart. And this is just from the last few months. Some people think this is a bear market rally. Some people think it's not. But this is the rally we've had over the last few months. So QQQ has gone up over 22%, where QYLD has just gone up over 8%. And this is the problem with the covered call ETFs, is that you're capping your upside when you have these recovery rallies, but you're participating in all the downside. So you can see in the bottom left chart, QYLD, after its small little recovery rally, which we capped because we sold covered calls against it, it is now almost back down to the lows and might possibly break them. Compared to QQQ, because we got the full participation in the up rally, we're still very far significantly off the lows. And this is the primary reason why covered call ETFs do so poorly in bear markets and in just any markets with drawdowns in general, because you're always capping your upside on the recoveries but participating in the downside. So I hope you like this video, and remember to like, share, and subscribe. Feel free to leave me a comment asking any questions or anything else you want to say. If you need anything else clarified, leave it down below, and feel free to ask me any other questions if you want me to cover other topics in the future.